One trade. That is not a metaphor. On August 5th, 2024, a crowded funding structure, running quietly in the background of global finance for years, began to crack. And when it did, markets around the world felt it almost simultaneously. That strategy is called the carry trade, and the version that nearly broke markets in August 2024 had its epicenter in Japan, funded in yen, leveraged to the hilt, and deployed across assets that had nothing to do with Japan at all. This is the story of how borrowed yen moves the world, and why, one day, it all came undone. The carry trade is, on its surface, embarrassingly simple. You borrow money in a country where interest rates are low. You convert that money into a currency where rates are high. You invest it. You pocket the difference. That is it. That is the entire strategy. Let's make it concrete. In early 2024, the Bank of Japan's policy rate was 0.1%. The U.S. Federal Reserve's rate was 5.5%. The spread, the carry, was 540 basis points. 5.4 percentage points of pure, riskless-looking income available to anyone who could execute the trade. Here is what that looks like in practice. If you're sitting there thinking, wait, why doesn't everyone just do this? You are asking exactly the right question, and the answer gets to the heart of a puzzle that has occupied international economists for 40 years. The theory that should prevent this trade from working is called uncovered interest parity, UIP. The logic is elegant. If Japan offers 0.1% and the U.S. offers 5.5%, then investors should rush to buy dollars and sell yen. That rush should push the yen down today, and because markets are forward-looking, the yen should be expected to appreciate in the future, precisely canceling out the interest rate differential. If UIP holds perfectly, the carry trade earns exactly zero after accounting for exchange rate moves. The 5.4% you earned in interest gets eaten by 5.4% of yen appreciation. You end up where you started. Here is the problem. UIP doesn't hold. Empirically, it fails, and it fails in the direction that benefits the carry trader. High interest rate currencies do not systematically depreciate by the amount theory predicts. Instead, they tend to keep rising, or stay flat, for extended periods. This failure has a name. Economists call it the forward premium puzzle, and it has been documented in the data since at least 1984, when economist Eugene Fama first identified it rigorously. If the carry trade is just pocketing an interest rate spread, you might expect it to be a niche strategy used by a handful of macro hedge funds. The reality is somewhat different. Let's start with what we can measure. The Bank for International Settlements, the central bank of central banks, reports that yen-denominated FX forwards and swaps reached approximately $14.2 trillion in notional value in its OTC derivatives statistics. Not all of that is carry trade exposure, but it establishes the scale of yen-related positioning in global currency markets. More specifically, BIS analysis of the August 2024 episode estimated the direct yen carry positions going into the event at a rough midpoint of 40 trillion yen, approximately $250 billion. And the BIS explicitly notes this figure is likely biased downward due to data gaps. Broader estimates, including structured products and bank yen funding to offshore entities, ran as high as 80 trillion yen dachus, or around $500 billion, before the event. Some non-BIS analyst estimates, accounting for a wider chain of yen-funded leverage through structured products and FX swaps, place the broader ecosystem much higher, sometimes in the trillions. Treat those figures as context, not verified exposure. The range is wide because, critically, no single regulator has full visibility. The carry trade lives in the gaps between central bank jurisdictions. Between 2020 and July 2024, the yen carry trade delivered returns that looked extraordinary. Dollar-yen went from 105 to 161. A carry trader who borrowed yen in early 2020 and invested in U.S. assets was collecting the interest rate differential and benefiting from yen depreciation, a double tailwind. The long-run empirical data paints a more sobering picture. A long-run study published in the Journal of International Money and Finance Analyzing carry trade returns across 20 currencies from 1900 to 2012 found sharp ratios of roughly 0.2 to 0.4 over the full sample period. Other modern samples, including Menkoff, Sarno, Schmeling, and Schrimpf, show stronger carry returns in some periods, but with the same crash risk profile. But there is a catch embedded in those numbers. Carry trade returns are negatively skewed. The distribution has a fat left tail. Most months, you collect a small, steady premium. And then, occasionally, you lose years of gains in days. For the yen carry trade to unwind, two things need to happen simultaneously. The yen must strengthen, and traders must be leveraged enough that the currency move triggers margin calls. On August 5, 2024, both conditions arrived at once, and they arrived from opposite directions. Trigger 1. On July 31st, the Bank of Japan raised its policy rate from 0.1% to 0.25%. This was a 15 basis point increase, small in absolute terms. But markets had been conditioned by years of Japanese monetary inaction. The signal was disproportionate to the move. Trigger 2. On August 2nd, the U.S. Bureau of Labor Statistics released jobs data showing only 114,000 jobs added in July, far below the 175,000 expected. The miss raised the probability that the Federal Reserve would cut rates sooner, narrowing the rate differential from both sides simultaneously. The combination was lethal for the carry trade. Between July 29th and August 5th, 6 trading days, the yen appreciated by approximately 6.15%. The dollar-yen pair moved from roughly 153 to approximately 144. That might sound like a modest currency move. For leveraged carry traders, it was catastrophic. Let me show you exactly what that 6% yen move meant for a typical leveraged carry position. Suppose a hedge fund borrowed 1 billion yen at 0.1% in January 2024. At 150 yen to the dollar, that's $6.67 million. The fund invested that in U.S. Treasury bonds yielding 5.5%. After 7 months, the fund has earned roughly $214,000 in gross interest income before yen funding cost. Then, the yen moves from 150 to 144. The fund needs to convert its dollars back to yen to repay the loan. But now, each dollar only buys 144 yen, not 150. The billion yen that originally cost $6.67 million now costs $6.94 million to repurchase. A currency loss of approximately $278,000, which more than wipes out the carry income. If the entry point was closer to 153, the FX loss is closer to $400,000. Either way, the 7-month carry premium vanishes. And then some. Here is where the carry trade becomes systemically dangerous. The unwind is not just a trade going bad. It is a self-reinforcing feedback loop, and once it starts, it accelerates. When the yen rises, carry traders face losses. Those losses trigger margin calls. To meet the margin calls, traders must sell their invested assets, U.S. Treasuries, emerging market bonds, tech stocks, and buy back yen. Buying yen pushes the yen higher, which causes more margin calls, which forces more selling, which pushes yen higher again. And because every step of this loop involves selling assets in other markets, those markets also fall, regardless of whether they have any connection to Japan at all. That is one reason crypto can sell off alongside equities during a funding shock. The macro story was not crypto fundamentals. It was forced liquidity. When leveraged traders face margin calls, they sell what they can sell, and that can include crypto positions. On that single day, the Nikkei fell 12.4%, Topix fell 12.2%, the S&P 500 dropped 3%, the VIX spiked above 65, dollar-yen moved from 153 to 144, Bitcoin fell roughly 15 to 20%, and popular carry currencies came under pressure. After August 2024, you might expect the carry trade to be finished. Burned traders, cautious institutions, a lesson learned. And for a while it was. CFTC futures data showed speculative yen shorts were cut sharply after the event. But by late 2024 and into 2025, market commentary suggested yen-funded positions were being rebuilt, drawn by a rate differential between the U.S. and Japan that, although smaller than at its peak, still presented a significant return opportunity. The logic had not changed. The interest rate gap was still there, and so the trade came back. This is the deepest puzzle, not just why UIP fails, but why the anomaly that should be arbitraged away keeps regenerating itself. Academics have proposed at least 4 explanations. None of these explanations is complete. The forward premium puzzle has been in the academic literature for over 40 years, and the conversation is still active. What we can say with certainty is this: the carry trade earns a real return. That return comes with a specific risk profile, negative skewness, crash exposure, and the structural incentives to rebuild the trade after each crash are powerful enough that it keeps regenerating. Consider the position of a large institutional investor in 2025. Japanese institutions, pension funds, insurance companies, banks collectively hold approximately $1.15 trillion in U.S. treasuries. These institutions have yen liabilities and large dollar portfolios, some hedged and some unhedged. When Japanese rates were zero, the economics looked simpler. Earn the U.S. yield, manage the FX risk. As the Bank of Japan raises rates, it reached 0.75% in December 2025 and held there in April 2026. The economics of these positions get squeezed, but unwinding them rapidly would strengthen the yen further, hurting the very positions they are trying to unwind. It is a structural trap. The unwind process is constrained by its own mechanics. The carry trade story is genuinely fascinating, but there are 4 caveats. The size numbers are uncertain. August 2024 was not a full unwind. The BOJ faces a real trilemma, and the strategy can be rational when positions are sized correctly. The danger is aggregate leverage before anyone sees it. 5 takeaways matter. First, the trade is a bet against a theory that has failed empirically for decades. Second, the structural rate gap still matters. Third, leverage turns a currency move into a global event. Fourth, the trade keeps rebuilding after crashes. Fifth, no single regulator sees the full exposure. The carry trade is not a scandal. It is not a conspiracy. It is the rational behavior of rational actors responding to a persistent anomaly in international finance, an anomaly that has existed through the floating rate era after Bretton Woods collapsed in the early 1970s, and that has survived every attempt by academic economists to fully explain it away. What makes it worth understanding is precisely its ordinariness. Somewhere in a fund you've never heard of, in a structure you'll never see, yen borrowed at near zero rates is deployed into assets you hold. The connection is invisible until the day it isn't. August 5th, 2024 was, in the BIS framing, a shock where broader market dysfunction was averted this time. One market estimate suggested the episode may have unwound only a fraction of outstanding yen carry positions. The rest likely remained in place. The rate differential, though narrower, still exists. Some positions appear to have been rebuilt. The structural features that made August 5 possible have not changed. What happens next depends on how gradually the Bank of Japan normalizes, how quickly the Fed cuts, whether markets give the system time to adjust, and whether the next shock, whatever it is, arrives slowly enough for leveraged traders to exit in an orderly way, or suddenly enough to trigger the same cascade again, at scale. The data ends here. The outcome does not. This video is educational.